Hello. Okay. This is Corruption through Dawa, Austin, Texas, 1:40 p.m. Something went wrong with the audio, so I'm doing this again. I have to restart my computer. I'm just reading the same PDFs I mentioned earlier, and I'll stream music. It's a nice sunny day. I had scones for lunch, I guess. Scones is a weird food. I don't have a lot of scones in my life, but I had some today. They were all right. Okay. All right. Music and paper screen. Bye.
गल सुन ललारिया वे आ लोक मेरे ते हसदे पैसे ज्यादा दे दूंगी मैचिंग कर देगा तां दस दे सुन ला वी डिट्टो सिम चाहिदी आला फोटो वे फरारी लाल दी चुन्नी मेरी रंग दे ललारिया वे चुन्नी मेरी रंग दे ललारिया मेरे यार दी गड्डी दे नाल दी चुन्नी मेरी रंग दे ललारिया वे मेरे यार दी गड्डी दे नाल दी ओ तां पंगे लगदे आ ओनू चंगे लगदे आ तां ही सोचां कुंडला पवा लवां सोचां शरेआम हो जा सोचदियां ना मैं ओदा गोटी उत्ते टैटू बनवा लवां सोचदी फिटालदी मैं फैंटम दे नाल दी मैं इक होर कुड़ती सवा लवां ओनू देख के तां मेरी हो जवे उम्र वधी दे नाल दी वे चुन्नी मेरी रंग दे ललारिया मेरे यार दी गड्डी दे नाल दी चुन्नी मेरी रंग दे ललारिया वे मेरे यार दी गड्डी दे नाल दी मेरे लिए देख ले जे कुड़ियां कवारियां ने देखी वे दुपट्टे तेरे विकदे इन्नी सोहनी चुन्नी लगे जट्टी ते लेके मैनू जदों ओह देखे गाना लिख दे कम मैनू बड़े सनियारे कोलों कड़े नाले हले मैं सफोरा गेड़ा मारना आउंदा ए प्यारे ओदा होना ए दीदारे ओदा जज नाल होई मैं तैयार ना डर लगदा ना किते रह जावां सद्दी ना सदी दे नाल दी वे चुन्नी मेरी रंग दे ललारिया मेरे यार दी गड्डी दे नाल दी चुन्नी मेरी रंग दे ललारिया वे मेरे यार दी गड्डी दे नाल दी औजले नू लोहर मेरी हो जवे घर दी गड्डी दे नाल दी वे चुन्नी मेरी रंग दे ललारिया मेरे यार दी गड्डी दे नाल दी वे चुन्नी मेरी रंग दे ललारिया मेरे यार दी गड्डी दे नाल दी वे चुन्नी मेरी रंग दे ललारिया मेरे यार दी गड्डी दे नाल दी चुन्नी मेरी रंग दे ललारिया मेरे यार दी गड्डी दे नाल दी
ठीक कहा तूने झूठ कहा मैंने सीज करूं मोमेंट बना पहले टूट बना मैं तो लूट रहा बन कर दोबारा से टूट रहा हर दिन गुजरता है जूझ रहा तेरी याद में स्विच फूक रहा चल संग करूं बैठ नोट बना फिर कंसल आता है डूब गड़ा किस्मत की चांदी है पिघली पिघली दिखती शक्ल अपनी धुंधली धुंधली संगम हो सबका सुतली वो बम सफट दुनिया छोटी है बिखरी बिखरी हम गम नहीं है जीवन यही है सिलिब्रेंट फिर से पर फन वही है पकड़ेगा क्या मेरा लन नहीं है आंखों के पीछे फंसे सभी है तो जीना है मुझको जीने दो जीना है मुझको जीने दो सागर की सतह से नीचे अगर मैं तैरूं मिलता हूँ मैं खुद की आदतों से मेरी जिंदगी में अहमियत के पहलू तेरी नजरों से मैंने देखे तेज हवा में लहराना मैं चाहूं सागर लगता सीमित मेरे मन को तेरे दिल की किरणें जो पड़ती मेरे ऊपर हो जाने दो जो कुछ भी हो जीना है हमको जीने दो
I might be a part of this, a ripple on water from a lonesome drip, a fallen tree that witnessed me, him alone, him and me. That life itself could not aspire to have someone be so admired. I threw creation to my kin with a silence broken by a whispered wind. Tip to tip, I look at him, my country chip, levered up by all his fears, with someone watching close to tears. Many chains and many miles brought you to me on this sunny isle, and one of which you wish to speak. Have you come here to rescue me? All of this can be broken, all of this can be broken. Hold your devil by his spoke and spin him to the ground. But I am your keeper, and I hold your face away from light. I am yours till they come. I am yours till they come.
Good morning, Myron.
Morning, Daryl.
Let's go right to the heart of the matter. What most people remember about your Nobel Prize in economics is that it led to a precise mathematical formula for the price of an option. And we'll get into the story of that in a couple of minutes. But for those of watching that don't know a whole lot about finance. What exactly is an option?
That question. Basically, an option is the right but not the obligation to buy a security at a fixed price over a set period of time. That's called a call option. And there's also other options which give you the right but not the obligation to do so, to sell a security at a set price over a specified time period. So the interesting thing about options are basically they are rights or ability to do something without the requirement to do something. So it's the flexibility or the optionality that we think about in life, and it's similarly it applies to securities as well.
So it could be equities, could be bonds, could
Correct.
even be commodities.
Correct. Equities, bonds, commodities, commitments, a lot of different things.
Okay, so now let's go way back in time. Think of yourself in the late 1960s. And a lot of things were going on in finance around that time. Major developments in the emerging field of financial economics. A lot of people had worked on how to price an option. It was a hard problem.
Electronic music success, DJs and
I'm
producers
just
in the mix.
curious to hear how
Today we're going to learn about the Black-Scholes model, and this is the last video in a series I'm doing on how to price options, and the first few videos are all on the binomial tree approach. Now, as I explained earlier on, the Black-Scholes model actually came before the binomial tree approach to pricing options, but I like to teach them in reverse order simply because the binomial tree relies on all of the same ideas as the Black-Scholes model, but the calculations are maybe a little bit easier to understand. We're not using calculus, we're using simple, addition, subtraction, multiplication, and division. In order to price our options using the binomial tree, but it's actually doing the same thing as the Black-Scholes model. And so I'd recommend if this is the first video you're looking at, it might not hurt to watch the other ones first. But anyhow, we'll move along. So the Black-Scholes-Merton option pricing model was developed in the 1970s, and it was a revolutionary model in finance. It's probably the most important piece of financial mathematics in the last 100 years, and the sort of piece of financial mathematics that was big before that was the idea of present value and cash flow. So it's quite a big deal in finance. It earned a Nobel Prize in economics for the inventors of the model. And the reason for that was because it was a huge breakthrough, and hopefully in this video we'll try and understand why it's a big deal and why it's useful. So just to be clear, it's not just that it told us how to price. It didn't just tell us the price is $2. What it told us is what the price is, but also how options behave, how to hedge options, and even how to create option-like payouts without there being a derivatives market available. So let's take a quick look at it. So the Black-Scholes model does require more assumptions than the binomial tree model does, and that's just because it's sort of a more beautiful piece of mathematics. But for that reason, in order to get all of those mathematics to work, we need more simplifying assumptions. So the first assumptions we need are about how stock prices behave. How does a stock price evolve over time? And so for the Black-Scholes-Merton options pricing model, our assumption is that the underlying has an expected return of mu, and that it has a standard deviation, or a sigma, that's held steady over the life of the option. And the assumption is that stock price returns are log-normally distributed. Now, these aren't perfect, they're not amazing, but they're all right. And we'll do some other videos later where we learn about things like volatility, smile, and so on, and we'll learn about how people who trade options in the real world adjust for these flaws in the Black-Scholes model, but just because these, we have to use these simplifying assumptions to make things, come up with a price that's, once we adjust for all of these other things. So let's move along. So that's the assumptions about how the stock price behaves. There's other assumptions as well. So we've got 7 assumptions here. We've got an assumption that mu and sigma are constant, so they don't change over the life of the option. We've got an assumption that there are no transaction costs or taxes. Now, of course, that's not the real world, but it's kind of required in order to price an option in one small formula rather than adding, all of this additional detail is problematic for pricing something using one formula. We've got another assumption that there are no dividends on stock. So that really just means that this model is not suitable for pricing options on dividend paying underlyings. And so we'll have to use a different method, and different models came out after the Black-Scholes-Merton model that dealt with that. But for the basic model, no dividends are allowed. There are no arbitrage opportunities available in markets. That's the same assumption as we had with our binomial tree, and it's a pretty reasonable assumption. And I can make another video at some point in the future about whether this financial assumption of no arbitrage makes sense or not. The next one we have, the next assumption is that trading is continuous. And so by trading being continuous, there's a few things that I mean. It means firstly that the market in the underlying and the option never closes. So there's no period in which it's closed. But not only that, it actually means that each price point that the underlying trades at, that there's that there's no gap between them. So in the real world, we'll say if a stock trades at $1 and then the next price is $1.01, the Black-Scholes model actually assumes that it trades at every fraction between $1 and $1.01. So that's not realistic. That's not how the real world is, but it's an assumption that's required, because essentially what we're doing here is we're moving from a discrete time model. So the binomial tree approach was a discrete time model, and the Black-Scholes model is a continuous time model. So we have to have this idea of continuous trading in there as well. And finally, we have borrowing and lending occurring at the same risk-free rate, which once again is a constant. It can't change over the life of the option. So the no arbitrage argument for the Black-Scholes is kind of what we worked through in the binomial tree approach, which is that if you could have a portfolio with some amount of stock, we'll call that delta amount of stock, and options that's riskless, we can then discount that back to the present value. That we can do the same sort of calculation we did in the binomial tree and present value it. So but it relies on this idea, and this is kind of a big part of the breakthrough, is this idea that there are portfolios, these hedging portfolios, where you have delta times the stock and the options all held as one portfolio. And once you're able to hedge like this, it's then reasonable to say that all of the risks of the option are offset by the offsetting position in the stock, and thus we can have this riskless portfolio that we can then present value with the Black-Scholes-Merton model, rather than adding all their assumptions as well. So we've got 7 assumptions here. We've got an assumption that mu and sigma are constant, so they don't change over the life of the option. We've got an assumption that there are no transaction costs or taxes. Now, of course, that's not the real world, but it's kind of required in order to price an option in one small formula rather than adding, all of this additional detail is problematic for pricing something using one formula. We've got another assumption that there are no dividends on stock. So that really just means that this model is not suitable for pricing options on dividend paying underlyings. And so we'll have to use a different method, and different models came out after the Black-Scholes-Merton model that dealt with that. But for the basic model, no dividends are allowed. There are no arbitrage opportunities available in markets. That's the same assumption as we had with our binomial tree, and it's a pretty reasonable assumption. And I can make another video at some point in the future about whether this financial assumption of no arbitrage makes sense or not. The next one we have, the next assumption is that trading is continuous. And so by trading being continuous, there's a few things that I mean. It means firstly that the market in the underlying and the option never closes. So there's no period in which it's closed. But not only that, it actually means that each price point that the underlying trades at, that there's, that there's no gap between them. So in the real world, we'll say if a stock trades at $1 and then the next price is $1.01, the Black-Scholes model actually assumes that it trades at every fraction between $1 and $1.01. So that's not realistic. That's not how the real world is, but it's an assumption that's required, because essentially what we're doing here is we're moving from a discrete time model. So the binomial tree approach was a discrete time model, and the Black-Scholes model is a continuous time model. So we have to have this idea of continuous trading in there as well. And finally, we have borrowing and lending. Black-Scholes model is we're moving that's required, but free fraction between $1 and $1.01. So that's not realistic. That's not how the real world is, but it's an assumption that's required, because essentially what we're doing here is we're moving from a discrete time model. So the binomial tree approach was a discrete time model, and the Black-Scholes model is a continuous time model. So we have to have this idea of continuous trading in there as well. And finally, we have borrowing and lending occurring at the same risk-free rate, which once again is a constant. It can't change over the life of the option. So the no arbitrage argument for the Black-Scholes is kind of what we worked through in the binomial tree approach, which is that if you could have a portfolio with some amount of stock, we'll call that delta amount of stock, and options that's riskless, we can then discount that back to the present value. That we can do the same sort of calculation we did in the binomial tree and present value it. So but it relies on this idea, and this is kind of a big part of the breakthrough, is this idea that there are portfolios, these hedging portfolios, where you have delta times the stock and the options all held as one portfolio. And once you're able to hedge like this, it's then reasonable to say that all of the risks of the option are offset by the offsetting position in the stock, and thus we can have this riskless portfolio that we can then present value at the risk-free rate. And so we then have to take all of the time periods of each riskless portfolio down to being instantaneous and continuously rebalance. So we're continuously rebalancing our portfolio to maintain that riskless nature. And we'll learn more about this in a future video that I'll do on dynamic hedging. But that the expected cash flows at the end of each momentary node can be discounted at R, which is the risk-free rate. So the Black-Scholes model, you'll see up on your screen right now. And there's actually sort of two models, where there's one for a European call and one for a European put, but actually they're the same model, right? The difference between them is just the put-call parity formula has kind of been built into one of them to convert one into the other. So we have up there the formula. There's probably no point in me reading it out to you. You can, if you want to read the formula, it's in the textbook that we're using, which is linked to in the description below, or it's written on the screen right now. But it's basically the formula for a call and a put, and then there's the formula for D1 and D2. So you firstly have to calculate D1 and D2, then we're using N of D1 and N of D2, N being the cumulative probability function for a standardized normal variable. And if you wanted to do that using, we'll say something like Excel, you can use the Excel function, which is equals normdist, N-O-R-M-D-I-S-T, and that will calculate the cumulative probability function for a standardized normal variable. So essentially, that is how you calculate the Black-Scholes model. So what does it mean? What are we looking at here? We can interpret the formulas as calculating weighted probabilities and values of the various share price outcomes versus the strike prices. Hopefully that makes sense to you. The Black-Scholes model tells us that we can perfectly price European-style options as long as the underlying asset moves in a Brownian motion-like manner, which means that it moves with a certain drift or expected return, which we call mu, and with a stationary volatility, which we call sigma, standard deviation. So in practice, this isn't a perfect explanation of how stock prices move, but it's a reasonable proxy. And since the Black-Scholes model, there have been a host of other models that are all essentially the same as the Black-Scholes model, but modified slightly in order to maybe make the behavior of stock prices a little bit more reasonable. But the core idea is the same. So, like any model, the Black-Scholes model is a simplification of a very complex system, okay? And that's always going to be the case with anything we do in financial mathematics, where you have to simplify simply because you can't perfectly model all of these things. If you did, you would know the future. But it's such a good model that it is extensively used, and really, as I mentioned, any other more recent models, when you look through the textbook and you see the other models, you can clearly see that they're just developments of the Black-Scholes model. So the core idea of the Black-Scholes model was a great breakthrough, and I don't think there's been a breakthrough of similar magnitude since in finance. So one parameter, so all of the things, if you saw the formula up on screen there, and you can see that you can plug in all of the specifications of the option and the price of the underlying and interest rates and things like that. But there's one detail that's not really observable in the market, and that is sigma, the volatility of the underlying. And if you remember when we looked at our binomial tree approaches as well, we had that all we needed to know to price an option was the price of the underlying and its volatility, right? So the question then we have to ask ourselves is, well, what do we mean by volatility? Where do we get that from? And so, the easy way you might try and answer that question, you should say, well, volatility is the standard deviation of the underlying. So all we need to do is get a time series of the underlying, calculate its standard deviation, and then we know the volatility. Now, there's a few problems with that, though, because if we were to download the data, we'll say you can go on Yahoo Finance and get stock price data for all of these stocks. You can calculate its standard deviation, but if you were to download 1 year's data, you'd get one standard deviation. 5 years, 10 years, 30 years of data, you'd get different standard deviations. And then even the question is, which one is most relevant, right? Because a company might have changed. If we looked at the standard deviation of Apple Computer over its 30-year life, a big chunk of it was sort of failing as a computer company, and then they came out with the iPod and the iPad and the iPhone, and it was a totally different company, right? So which standard deviation do we use? And the answer is none of those standard deviations. The standard deviation that is required in both the Black-Scholes and our binomial tree approaches is actually a forward-looking standard deviation. It's the standard deviation over the life of the options. It's a standard deviation that hasn't happened yet, okay? So that's problematic, right? So using a bunch of data that's available in the marketplace, plus one number that's not available, the forward-looking standard deviation, we can price an option. And so you might say, well, Patrick, you've led us through, I don't know, what is this, the 6th or 7th video on how to price options, and you didn't tell us that one of the numbers we need is not actually available. It's true that number is not available, that you can't know how volatile something's going to be over the last month. But they're actually, interestingly enough, one of the things, up until now we've been saying, how do you price an option? But we actually do know the price of an option, right? It's the price that someone will buy it or sell it at from us, right? That's actually out there in the market. So we don't know the volatility, but we do know the price of the option, right? You can call up your broker and find out the price of an option. So what do we do with that information? Well, considering we do know the actual price of the option, instead of us solving the Black-Scholes model to get the price of the option, what we can do is we can put the price of the option in there and solve for what the volatility is. Now, is that useful? It actually is quite useful, because it allows us to compare the price of a whole bunch of different options to each other, and it allows us to understand how much people think the underlying is likely to move, how volatile it's likely to be. So the volatility that we back out using the Black-Scholes model is what we call the implied volatility. It's how volatile the market thinks this underlying will be given the price that people are paying for or offering to sell options at, okay? So that is sort of the sum of everyone's best guess as to how risky this is, and this implied volatility is actually such an important feature of options markets that most options are actually quoted based on implied volatility alone. So if you maybe not on a sort of a retail trading platform, but for institutional options trading, if you call up a derivatives broker and ask for a price of an option, they don't tell you a dollar price, they'll tell you an implied volatility, and then you use that to infer the price of all of the different options that might be out there. And so what we've actually learned here in this sort of circuitous way is that the price of an option actually just really is the implied volatility of an option, right? What we're saying is that the more an underlying moves, the more an option is worth, and so we're able to see what the market thinks an underlying will move by looking at options prices. And so in the options market, options traders are usually referred to as volatility traders or vol traders, and that's because volatility is the key feature being traded in the option space. So when you're buying options, you're buying volatility, and when you're selling options, you're selling volatility. You're betting that the price of the option is too high, and what you mean by that is that the implied volatility that's been put into the formula in order to price that option you think is too high, and that you think the underlying will be less volatile than that. So that's bringing us to a certain point where you might start to wonder, well, how do we, it's all very nice that you're trading volatility. How do you do that? Well, I'm going to put up a video in a little while on dynamic hedging, which will explain how you trade volatility, how you actually profit from how volatile or how calm an underlying trades in the real world by trading an option against the underlying. And all of the information we've learned in this series of pricing options is actually important to understand that stuff. But I guess the takeaway at the end of this video on Black-Scholes is that the price of an option actually just is the volatility of the option, and that derivatives professionals are primarily placing bets not on the direction of the underlying by buying and selling options, because they can make that bet by just buying and selling the underlying. They're actually making bets on how volatile that underlying is. So they're primarily placing bets on the pricing of implied volatility of the underlying as opposed to the direction of the underlying. So where do we see this volatility? Well, one place you can see it is with the VIX index. Okay, the VIX index is an index of overall market volatility. It is the most popular index of expected market volatility on 1 to 2 month options on the S&P 500. So the S&P 500 is a big equity index, and the VIX tells us how volatile people think that will be over the next 1 to 2 month period. So the VIX is an index that you can look up online and see sort of how volatile people expect the overall market to be. There's also actually futures and options available on the VIX. So you're able to buy futures betting on an increase or sell futures and bet on a decrease in the VIX. Or you're also able to trade options on the VIX, which is like volatility on volatility. Now I'll put up on the screen a chart of the VIX. Here you can see a chart of the VIX, and as you can see there's a number of big spikes, and that's really just when implied volatility went really high. Now you can see in there the 1987 crash. You can see things like what have we got, the Asian crisis in 97, the long-term capital management meltdown in 98. You've got September 11th is in there, 2001. You've got the meltdown of the dot-com stocks in the early 2000s. You've got the credit crunch. There in 2011, you can see a spike that related to the Fukushima nuclear reactor meltdown in Japan. And so as you can see there, whenever things get scary in the stock market, volatility goes up, and we've sort of said volatility is the price of options, right? So what we're saying there is that when scary things happen in the market, people don't want to sell options, and by that I mean both puts and calls, right? No one wants to sell you a put or a call unless you pay them a lot more money for it, and the price of the option really just is this implied volatility. So that's it for this video. We'll kind of continue on and learn more in coming videos. So see you again soon. Bye. In today's video, we're going to learn about option pricing, and in particular option pricing using the binomial tree. And in the textbook that we use, there's a link to that in the description below if you're interested. In the textbook, we look at two approaches to the binomial tree. And so for this video, we're going to look at the first one, which is the portfolio approach to pricing options using a binomial tree. Now, it's worth noting that the Black-Scholes model was actually developed before